Ladies and gentlemen, welcome back to Schaeffer's Market Mashup. It's been a while, friends. Over a month, I took the entire April off from the podcast world to get some much needed R&R, but I am back, I'm rejuvenated, and I'm thrilled for this week's episode. It's a topic that has been buzzing, I feel like, in the investing world for a long time, so I'm thrilled to have some experts here, unpack it all for you all. Please welcome Arianne Adams, Head of Derivatives and Global Client Services at Cboe. Arianne, how's it going?
Great. Patrick, it's great to be with you today.
And I also have Dave Harap, Portfolio Manager at Norcap Investment Management and fellow Connecticut person that I just found out before the episode. David, how are you?
I am wonderful. Thank you for having me on. I'm looking forward to it.
Great. So before we jump into this, we're going to talk about weekly options, and I pulled some stats from Cboe's website. I think that were just released in the last week. April volume was at 26.9 million weekly options volume, which is a record high. That comes out to an average daily volume of 1.3 mil. So this is a topic on the forefront of a lot of people's minds. Hopefully it articulates a lot of things that retail traders are looking to find, looking to learn more about. I even saw Forbes put out an article they called weekly options trading the scalpel of the investing world, which I love that analogy. Approximately 40% of total U.S. options volume last year were in short-dated contracts. That's double the level traded in 2017, which was 5 years ago. And so we're talking about specifically options expiring within 5 days or less of a trade date. So, Arianne, I'll let you go here first, and then Dave can take it. From your perspective, what's been driving this insane insane growth in short-term options trading?
Yeah, it really has been insane here, Patrick. I think I'll touch upon 2 points. One from a macro perspective, and then second, probably teeing up Dave pretty well, talk a little bit about the customer demand that we're seeing from an exchange perspective. But the prior first, these volatile markets, I'm looking at the market today, SPOs are off 130 points as we have this discussion. And that has been consistent that we've seen over the past couple of years. And that has led to investors really needing to have more precise risk management tools for them to hedge, trade intraday volatility or these intraday types of moves. And a lot of times we've seen investors turn to index, ETF, the stat you just gave with regards to SPX options to meet their trading needs. So the second point, thinking about the customer demand, the rise of the retail investors alongside the institutional investors have definitely contributed to the increase in these volumes that we've seen over the past few years. These retail investors and even institutional investors tend to gravitate or think about buying options, often shorter dated options, in less than a month of expiry. And one of the attractions is really the ability to define your investment outcomes in a short period of time, a day or two even. And you mentioned under 5 days. We will give some stats later in terms of how short dated the trading profiles we're seeing. But given these short-term nature and short-dated options, this allows traders to really make quick, targeted responses to these movements, even intraday, by using a broad market or an underlying ETF or stock with greater flexibility and precision. And the desire and the demand to utilize these shorter-dated options has really taken off. So with regards to some of the statistics that you just mentioned, I'll dig a little bit deeper, but the rising demand for short-dated options that are reflective in our S&P complex, SPX, is our index option. And I'll give you stats with regards to our weekly options. They're comprised of approximately 59% of weekly options, of our total option contracts. Excuse me, let me take a step back. Our weekly options accounted for 59% in 2019. And that's steadily increased that now in 2020, 62% of our S&P volume was weekly options. And then now, as we close 2021, 72% of our volume is traded in a weekly contract.
Wow. And
that is reflective in some of the ADV that you gave. You started with 1.3. So in our SPX weekly ADV was 754,019, 759,000 in 2020, and 981 in 2021. So clearly we're seeing that increase in demand, desire from our customer base. But, speaking and having David on the call here, he can talk to it firsthand.
So I just want to, state, these are my opinions and not that of Norcap. So I just want that on the record. But, so like what Arianne said, the weekly options has been a, wonderful addition. They're always on the forefront of coming up with great ideas, especially they knew that their customer base needed this, wanted it. It meets like a very unmet area where you can be so precise on just your spreads on risk. The duration in buckets, we now have tighter buckets. I remember back when I started, they just had one expiration a month. And so a lot of people would trade between the Cboe and the Merck. The Merck had the S&P product, but it was an American option that expired at the end of the day. And we expired on the print Friday morning. And so we always had that exposure on that Friday of holding on to positions that we had spread off throughout the course of that month. And that last day we were exposed to the market at the Merck if we couldn't zero out the position. But by zeroing out the position, during that week, you'd have to give up a lot of edge in order to pair off your risk. So now with the introduction of weeklies, and now weeklies every day, you don't have to do that anymore, because now we could have both options expiring at the same time. For Norcap, we now are super excited because we actually, like, our wheelhouse in bread and butter is like the first 90 days of option expiry. So we love to just keep rolling the risk out every day now, and it just makes things so much easier for us. I also think that the weeklies were, again, I think just with more sophistication, when you get more people aware of how powerful it is and how well you can use it to manage risk, that's why you're seeing like an increase in volume and interest in the weeklies.
Mm-hmm. Both of you mentioned numerous times risk and hedging, and that is so important now in this current broad market choppiness. So, Arianne, you can take this first again. Do you think that choppiness is eventually going to scare off options traders, or do you think instead that's going to make them double down and almost focus more on these shorter time frames?
I think this is a great question, Patrick, and it's one that we continue to monitor. And I think that the prior is probably more what we're seeing the latter is what we're seeing rather than the prior, meaning these market environments really has not scared off the retail and or institutional investors. I think that they've gotten smarter, more nimbler on how they're approaching the marketplace, whether that's reducing exposure in single stock names and increasing exposure in macro indices or ETFs to protect portfolios tends to be some common themes you see when there's such a significant down day like we're experiencing today. So when you have these rapidly changing market conditions, rising rates, the Ukraine war, things transpiring overnight from the U.S. session, is when you start to see these types of trading patterns accelerate with regards to maybe more reliance upon index options. Furthermore, even digging a little bit deeper, you start to see that investors have really thought thoughtfully around the relationship between implied and realized volatility, and times when implied vols have really traded under where they're realizing. That screams that the market, or maybe that investment theory, is running a little bit cheap. And we've seen net buying or inflows where investors continue to look for value in that hedge or that option contract to combat some of the, or realize some outsized gains, not only in the marketplace, but in that volatility in that contract. And now with the S&P clearly today, maybe even approaching year-to-date lows, owning short-dated options has been attractive from owning a gamma perspective, given the existing market conditions. And these intraday swings tends to accelerate that gamma position, and it increases the likelihood of large intraday moves and a better break-even possibility. And that's where we've seen an acceleration in volumes in shorter dated contracts to capitalize on some of these differences between implieds and realized, as well as accelerating levels in gamma. So I think, coming back to the original question, I think traders will continue to be nimble and opportunistic, but they remain active in the marketplace. But no better to answer this question is obviously David, who's actively involved in the market right now.
Right. So yeah, thanks, Arianne. The weekly, it's more of, like Arianne was saying, that you can just target on a shorter duration and have that protection. Now, for us, it's very different than like a market making group that they love to have. I mean, there was a time where we hated expiration. And that to even think about having an expiration every day of the week would be overwhelming. But again, we've adapted. We've become nimble. We've become more educated on how powerful having this kind of product out there is. Yesterday, Fed comes out. We all assume that if they did 50 basis points, the market would most likely react positive to that, knowing that 75 basis points was off the table. We anticipated, obviously, we look at the VIX, and we anticipated all to come off. So you could have made bets on that day, like right after the Fed meeting. You can put on a structure while he's talking. And if you have a good feel for what direction, you can put a bet on just for that day. Now, granted, if your bet's wrong, you're going to be out that premium that you laid to put on that structure. But it's nice that there's so many people now that can play intraday every day on earnings, on the Fed, on any macro events. And it's just a great way to hedge risk. I mean, if you have a stock that's coming out with earnings that evening and we didn't have an option the next day, now we do. And you can protect your portfolio that way. So it's just the flexibility, the precision that you can put on bets without having to wait several weeks for that bet to pay off is just an amazing thing. And I think the more people are aware of it, the more interest and the more volume we're going to see. So, I mean, I'm surprised on how liquid these weeklies are. Even for us, we trade, it's pretty big size, and we're able to get our structures done for, within a dime of where we thought theoretical value was. So it's great for us.
Mm-hmm. I think you couldn't have picked a better 2 days when you look at yesterday and today, as far as the S&P's intraday moves, to underscore the importance of these short-term options, because this is example numbers A, B, and C right there, with their importance. But So Cboe is, you guys pioneered the short-term options trading in 2005 with the market's first weekly expiring options, SPX weeklies. So Cboe offers these weekly options that expire every Monday, Wednesday, and Friday. And then, of course, the reason why we're here, you recently added new Tuesday expirations, and then you will be launching Thursday expirations on May 11th. Arianne, you can take this first. What is the significance of these new Tuesday and Thursday options? And have you seen any insights from the initial trading volumes and activity?
Yeah, no, that's great. It has been a perfect timing. One would say maybe we're lucky, or we just kind of hit the timing right with regards to adding these incremental or these additional expiries. But one can care to estimate or guess. I'll leave it to you. But that being said, we just spent a tremendous amount of time talking about the macro environment, the geopolitical concerns, the volatility in the marketplace, and then David spending time talking about the customer demand, the precision he needs and desires to be able to really be successful and profit from his trading strategies. From an exchange perspective, those are out of our control. But the most important part is we're listening. We're listening to what Dave has to say, what our customers have to say about wanting and desiring the ability to have more precision around these trading strategies. So what did we do? Clearly, we think about how we can increase access or ease of access to the marketplace. And that went really into the decision of why we listed Tuesdays and about to list Thursdays next week. And it was obvious in the data. It was obvious in, and the inbounds that we're receiving from customers that wanted to be a little bit more nimble in their trading strategies. So, and it was a natural step in the evolution of developing these products. So I think you mentioned that, we've talked about the demand when we announced these in 2005, and that has steadily grown. And we really wanted to build upon the success to meet the growing customer demand. So when we get to next week, we will have an expiry every day for 2 straight weeks. We continue to get demand for people to say extend that profile, maybe not just 2 weeks, but maybe 3 weeks or 4 weeks. But stay tuned on whether or not we do that. I think time will tell, but there is inbound demand on wanting to be a little bit more precise, further out the curve, meaning out 30 days. So what are some of the insights we're seeing from what we did from launching the Tuesdays 2 weeks ago? It clearly was a smooth launch on April 18th, and we're seeing strong volumes early days. I know that Dave mentioned, his execution quality. We've had, and we continue to speak strongly about our market quality, especially when we're seeing days like today, that our liquidity providers are doing a tremendous job providing liquidity around the clock. And that comes from 10 plus liquidity providers that are there quoting daily on our behalf for the S&P product. In the first week, the SPX Tuesdays traded over 900,000 contracts and growing. And more than 600,000 contracts were traded on the first Tuesday expiry, which was Tuesday, April 26th. And a meaningful portion of those were traded on the day it expired, meaning that on April 22nd, that Tuesday contract expired. We were seeing a substantial amount of interest and demand for people to be trading that contract over the course of the day into expiry, just to be even more precise in capturing some of the intraday moves attributed to that daily trading profile. So we don't have kind of perfect clarity in terms of what customer positions look like. But one thing we've been able to glean from this data set is that these higher volume days bring the occasional trader into the marketplace to trade. But by having these tools that allow for the precision and for customers to express their opinion on the market outlooks for that particular day. And that's pretty powerful. And that really helps not only the occasional trader, but those who and those who rarely trade, but those who trade frequently because they're in a position to be more precise with their investment decisions.
Dave, I have a broader, almost existential question for you, complete with a pun, as always. With all of these, more precise devices, are more options, pun intended, better for a trader? Or is more control always better?
Yeah, 100%. The more optionality you have, the more ways to hedge risk, put on risk, and in a shorter duration is just that much more powerful. And it actually allows you to trade larger than before. So you're more confident putting on more risk because you know that you can hedge that risk the following day instead of having to pay a much bigger premium with the only next expiry, which could have been a week out, or it used to be a month out. So now you can narrow that risk profile to one day, which is an amazing thing. So for us, we're really excited, and we can't wait for the Thursday option to get on board because we roll every day. We're rolling. So this just gives us one more advantage to try and squeak out some better returns.
Mm-hmm, mm-hmm. And I know we danced around this before, but Arianne, what is the case for trading options on an index like the S&P 500 as opposed to single stocks or ETFs? And
first and foremost, all products that are available to be traded in the U.S. listed option market environment benefit all investors. That being single stock equity options, to your point, ETFs, as well as indices and index options. And there's reasons and rationales at different periods of time where people might be more focused on single stock equities, catalysts, and moves, and other times, like the current trading environment, where there's a means and a need for more of a broad-based index to be able to, one, manage exposure, hedge exposure, and trade around intraday moves. So to the latter point, the S&P 500 SPX options is really a way to provide a broad provide broad exposure to the U.S. listed options marketplace and manage that macro risk attributed to that jurisdiction. The easy and possibly well-known benefits to utilizing index contracts is that they're cash settled, cash in and cash out when you pay in, and they're also European settled. So trading accounts are credited or debited for the cash they pay or receive when they trade, open and close a position. Not like an ETF or a stock share, which there is, physically settlement or a stock attributed to that settlement. And then furthermore, with regards to American exercise versus European exercise, there's the benefit of an index option is a European exercise. So there's no risk of an early assignment of that contract. Another key part where we were really listening to our customer demand from an index option perspective is that these global geopolitical macro events don't just happen during the U.S. hours. People want to have the ability to manage around the clock, and that caused us to extend our trading hours for the S&P and VIX contracts overnight. So the ability for you to start trading an S&P option at 8:30 Central Time through the following day to 4 p.m. Is available to you, 4 p.m. Central, that is, to you now, because there's constant need to hedge your risk and adjust your risk profile. That's not similar for ETF options, which are just trade during the normal continuous session of the U.S. market. And then lastly, there is a tax treatment benefit for cash settled index options, 60/40 cash treatment. As many people know, the capital gains may benefit from a 60/40 cash treatment under Section 1256 of the tax code. But as you know, I'm not a tax advisor, so make sure that you consult your tax advisor when looking for those benefits with regards to some of the benefits of trading index options. But those are just a couple that came to my mind, Patrick, and wanted to make sure we went through a couple of the benefits utilizing index options versus ETF and single stock equity options.
Good job, Arianne. That you nailed it on the index. Why that would be more attractive, and so yeah, I think especially like in a situation like today where the market's down 120 again or 130. I'm not even watching, but the index captures that whole move. If you were to just trade a single stock, even if it was a driver of the S&P, you're not necessarily going to get that protection or that exposure that you're looking for in order to protect your position. So it really depends on like what your objective is, right? So it depends on the individual, the company, what they're trying to achieve. So if it's like capital preservation, where you're trying to protect a portfolio of stocks, then I definitely strongly recommend using index options for protection. You can buy puts against it in uncertain times, or you can, what you've heard, covered calls. You can sell calls against your stock. But it depends on the individual, right? So in every environment, like whatever vol regime we're in, you have to adapt to it, and your strategies may work in one regime, but it doesn't work in the next regime. So you need to, identify what regime we're in, and then structure positions around that regime. So it's ever changing. You have to be able to change your ways depending on like where vol is trading. So we look at the VIX as an indicator, or sometimes it's a laggard, but like a lot of times you see the VIX creeping higher, but like the index, the SPOOs aren't even moving yet. And that's an indication that something's about to happen. And so then you do have time to like prepare yourself, because you should make an assumption that if the VIX is creeping higher, the market hasn't reacted yet, we're expecting a down move, because the VIX VIX only goes up when the market goes down. And that's because of skew. So we have an elevated put skew. So as the market goes down, the vol goes up. As the market goes up, we have a negative call skew. So then the VIX comes in. So I wouldn't really suggest a specific strategy for people, other than to just like do your homework and watch and observe, and maybe put on some paper trades and see how those perform in different environments. And if they work, then try them on and small, and then if they keep working, then you can establish a bigger position on it. But with the weeklies, it provides you an easy in and out. So you definitely can play for less if you're like buying options on such a short dated outlook. It's not going to cost you as much. What other questions, Patrick?
Well, first I wanted to note that I liked how you mentioned the adaptability. As the investor must be mindful of what the climate is, what the ecosystem is, and be ready to adapt. So I guess to wrap up here, and Dave, you can take this. Looking ahead to the rest of the year, how is your firm navigating an uncertain market environment, and where do you see potential opportunities for investors and the risks that come with them?
Sure. So we are projecting for some volatility throughout the remainder of the year. Just there's too many unknowns. The market doesn't like uncertainty. So the Russia-Ukraine conflict, Fed rates, inflation, supply chain issues. I mean, all these things are creating a little chaos in the marketplace. The market doesn't like that. So just be nimble. For us, we actually enjoy like elevated vol. So, but one of the best for us, it's fine. In our area of expertise is like lower delta areas of the delta buckets. So we're usually not exposed immediately to any undulations, any oscillation of the market. But higher vol is good for us. We typically put on some structures where we collect premium, but we still have net units, so we have protection. So the higher premium we're getting, the better returns we're getting. I would just say be cautious. We like yesterday with that huge up move, we definitely didn't think it was justifiable, and so we definitely expected a down move today, not as extreme or severe as we had, because it gave back everything yesterday and then some. So, but those are things that this market's going to do right now. And as long as you have an elevated VIX, the VIX is basically essentially telling you that, like yesterday going in, it said we're going to have implied a 2.5% move in the underlying, and we did. We actually exceeded that. So realized outperformed implied, but typically implied and realized always merge. So the marketplace is pretty sophisticated, and they're pretty good at like pricing options. So usually just come up with some good structures that could, if you have a bias to direction, that you think you're going to be right on, then you have to structure it with buying like a put spread if you think to the downside, buying a call spread to the upside, but don't put on too much exposure to risk, because this market right now is a bit chaotic.
Yes, couldn't agree more. And I like how you said the higher vol is your friend. I think that's an important thing.
It can be your friend. It can be your friend. It's not always your friend. So if you ended up selling, vol at 15 vol and now it's trading 25 vol, well, if you don't have enough money in your account, you will get a margin call, so you'd be forced to have to cover that. So you don't want that. You always want some gunpowder. So if you do have that kind of strategy, it's scalable, and so you can participate in getting some different prints along the way instead of putting all your eggs on one trade. You gotta just be patient and systematically be able to trade in and trade out of stuff.
Mm-hmm. Gunpowder, I like that.
Yeah.
I'm ready to wrap here. This has been a blast. First of all, I want to shout out Arianne. I know I looked you up. I know you swam at Penn State, but you really should have been playing team sports with the way you set up David on a couple of those initial questions. I just wanted to give you a shout out there.
Yes.
You were the perfect assist person there. No, but Arianne and Dave, thank you so much for coming out. This is a topic I think we can keep exploring, especially as this volume and demand continues to rise. So hopefully this isn't the last of our conversations.
Sounds good. No. Thank you for the time.
Yep, so it's been great, Patrick. Thanks for the opportunity to speak a little bit about the weekly options.
Take care.
Thank you. Have a great day.